Hey everyone, Graham Stephan here. In the world of business, unexpected events are a fact of life. Whether it's a customer defaulting on a payment or a sudden economic downturn, companies need to be prepared for anything. That's where provisions and reserves come in. These accounting tools help businesses set aside funds for future uncertainties, ensuring they can weather any storm. In this deep dive, we'll demystify the concepts of provisions and reserves, explore their differences, and understand their importance in maintaining financial stability. By the end, you'll be well equipped to navigate these crucial accounting concepts. Let's get started. Provisions and reserves are often used interchangeably, but they represent distinct accounting concepts. Let's break them down. A provision is an amount set aside in a company's accounts to cover a future liability or loss that is probable and measurable. Think of it as a rainy day fund specifically earmarked for known potential expenses. For example, a company might create a provision for doubtful debts to account for customers who might not pay their invoices. On the other hand, a reserve is an appropriation of profit set aside to strengthen a company's financial position. Unlike provisions, which are linked to specific liabilities, reserves are more general. They act as a financial cushion, providing a buffer against future uncertainties or opportunities. A common example is a general reserve which companies create to fund future expansion plans or unexpected contingencies. While both provisions and reserves involve setting aside funds, there are key differences between the two. The primary distinction lies in their purpose. Provisions are created to cover specific, identifiable liabilities or losses, while reserves are more broadly used to strengthen a company's overall financial position. Another difference lies in their impact on a company's profit. Provisions are treated as an expense on the income statement, reducing a company's reported profit. This reflects the fact that provisions represent a probable future outflow of economic resources. Conversely, reserves are appropriations of profit and do not impact a company's reported profit. They are reflected in the balance sheet as a part of equity. Furthermore, provisions are often mandatory under accounting standards, particularly when dealing with potential liabilities. For instance, companies are required to create provisions for doubtful debts based on their assessment of outstanding receivables. Reserves, however, are generally discretionary, meaning companies have the flexibility to create or not create them based on their financial strategy. Let's solidify our understanding of provisions and reserves with some practical examples. Imagine you're the accountant for a furniture retailer. At the end of the year, you need to create a provision for doubtful debts. Your analysis of outstanding receivables suggests that 3% of sales made on credit are unlikely to be collected. The total credit sales for the year amounted to $500,000. The provision for doubtful debts would be calculated as follows. Provision for doubtful debts equals 3% of $500,000, which is $15,000. The journal entry would be debit bad debts, expense $15,000, and credit provision for doubtful debts, $15,000. Now, let's say you're the CFO of a tech startup that has experienced significant profit growth. To safeguard against future uncertainties and fund potential expansion plans, the board decides to create a general reserve of $1 million. The creation of the general reserve would involve transferring $1 million from the company's retained earnings to the general reserve account. The journal entry would be debit retained earnings $1 million and credit general reserve $1 million. These examples illustrate how provisions and reserves are used in real-world scenarios to ensure financial prudence. Section 5. The importance of provisions and reserves, safeguarding financial health. Provisions and reserves play a crucial role in maintaining a company's financial health and stability. Let's explore their key benefits. Firstly, provisions ensure that a company's reported profit is a more accurate reflection of its financial performance. By accounting for potential future losses, provisions prevent companies from overstating their profits, leading to more informed decision-making by investors and stakeholders. Secondly, both provisions and reserves enhance a company's financial stability. By setting aside funds for future uncertainties, companies create a financial cushion that can help them navigate unexpected challenges without jeopardizing their operations or long-term viability. Thirdly, mandatory provisions, such as those for doubtful debts or warranty claims, ensure that companies comply with accounting standards and regulations. This fosters transparency and trust in financial reporting, making it easier for investors and creditors to assess a company's true financial position. Lastly, reserves, particularly those earmarked for specific purposes like business expansion or research and development, can be instrumental in driving a company's growth and innovation. By setting aside funds for future opportunities, companies can invest strategically without relying solely on external funding sources. Section 6. Common misconceptions. Debunking myths about provisions and reserves. Despite their importance, provisions and reserves are often misunderstood. Let's debunk some common myths surrounding these accounting concepts. Myth 1. Provisions and reserves are the same thing. As we've established, provisions and reserves are distinct concepts. Provisions are specifically linked to probable future liabilities, while reserves are more general appropriations of profit. Myth 2. Creating provisions and reserves reduces a company's tax liability. While provisions do reduce a company's reported profit, which in turn could reduce its tax liability, this is not their primary purpose. Provisions are created to reflect a company's true financial position and should not be used solely for tax avoidance purposes. Myth 3. Reserves are only for large corporations. Companies of all sizes can benefit from creating reserves. Even small businesses can enhance their financial stability and seize growth opportunities by setting aside funds for future contingencies or investments. By dispelling these myths, we can gain a clearer understanding of the legitimate role provisions and reserves play in sound financial management. Section 7. Provisions and reserves across industries. A glimpse into different sectors. The use and application of provisions and reserves can vary significantly across industries, reflecting the unique risks and opportunities inherent in each sector. In the construction industry, for example, companies often create provisions for contract losses to account for potential cost overruns or delays in large-scale projects. Similarly, manufacturing companies might create provisions for warranty claims based on the estimated rate of product defects. In the technology sector, companies often create reserves for research and development to fund innovation and stay ahead of the competition. Likewise, pharmaceutical companies might create reserves for potential legal settlements related to drug patents or product liability claims. These examples highlight the adaptability of provisions and reserves as tools for managing financial uncertainty and pursuing growth across diverse industries. Section 8. The future of provisions and reserves. Adapting to a changing landscape. The accounting landscape is constantly evolving, driven by factors such as globalization, technological advancements, and changing regulations. As businesses navigate this dynamic environment, the role of provisions and reserves is likely to become even more critical. The rise of artificial intelligence and machine learning is already transforming how companies assess risk and make financial forecasts. These technologies can analyze vast amounts of data to identify patterns and predict future outcomes, potentially leading to more accurate and timely provisions for liabilities. Furthermore, as businesses expand their global footprint, they face a wider range of geopolitical and economic risks. Provisions and reserves can provide a vital buffer against these uncertainties, enabling companies to adapt to changing market conditions and maintain financial stability. Section 9. Conclusion. Embracing financial foresight. In conclusion, provisions and reserves are indispensable tools for companies seeking to navigate the complexities of the business world. By understanding the nuances of these accounting concepts, businesses can make informed decisions, safeguard their financial health, and position themselves for long-term success. Remember, provisions and reserves are not just accounting entries, they represent a commitment to financial prudence and a forward-thinking approach to managing uncertainty. By embracing these tools, companies can confidently face the future, knowing they have the financial resilience to weather any storm and seize emerging opportunities. If you found this deep dive into provisions and reserves helpful, be sure to give it a thumbs up and subscribe to my channel for more insightful content on finance and business. Until next time, stay informed and stay ahead of the game.